do it your own. Sometimes you have to partner. Okay guys, it is time to start driving. So every day I still try to get you guys as much information as I can to make you guys successful in your businesses. Today we'll talk about is short-term loans. Okay, so short-term loans are going to be anything that is considered just bridge. Okay, and what does that mean? A lot of people, you'll hear the term bridge. Okay, so a bridge loan is considered something to where there's point A, there's point C, and there's B in the middle, which is always time or renovation or something like that, because you don't have to do construction. Sometimes bridge loans are just something that that you need more time on, like you want to get out of another hard money loan and you want to bridge for more time. All right, it's called a stabilized bridge. Okay, so short-term loans in Texas with Jet. So one thing that makes us special is that short-term loans in Texas with Jet, you can actually come $0 out of pocket at closing. I just did a video going through all the math and like showing the math and how to negotiate in real time. It's called How Does Hard Money Work? Go to our YouTube page and check that out. You know, like, subscribe, and comment to make sure that we're getting you the information you need to actually be really successful in any market. Okay, so when you guys are using your short-term loans, some key variables that you want to kind of look at is your total your top loan to value can be up to 70%. All right, so if you do the math and you are let's call it $100,000 total loan for like easy math purposes, okay, that means I can lend you 70 grand. Now let's say you needed 30,000 to renovate the property. So I take 30 out of the 70. I hold it in escrow. You do work. I reimburse you for completed work. So you net zero for the actual repairs. So that means if I did 70 minus 30, that leaves me $40,000 to lend at closing. Okay? So if you bought the property for $30,000, and I'm closing at title as your lender with $40,000 that we're advancing, that means I have $10,000 to roll in all your closing costs. That's your origination and your title fees and your legal fees and all those things. That is how you come out of pocket $0 at closing. If you bought it for $50,000 and I'm closing with $40,000, you have to make up the difference of that $10,000 plus your closing costs. So I give those two examples. So when you guys are at somebody's property trying to estimate, you can, and you didn't have a lot of time, you needed quick math to make up a number. You can start utilizing those strategies to see what ballparkish am I out of pocket at closing. And that really just gives you your out-of-pocket number at closing, okay? Because there's a little bit, you know, it's not adjusting for like title fees and stuff, things that like you can't control, your lender can't control, or anything like that. But it gives you an idea, okay, of your total dollars out of pocket. So that is basically how loan-to-value lending works. I'll get a lot of questions. And the reason why I do these videos is because I get these common questions. They'll say, oh, you guys lend up to 70%. That means I got to put 30% down. No, it's 70% of the after repaired value. minus the repairs at closing. So depending on how you bought it dictates if you're out of pocket at closing with loan to value lending. There's another product on short-term called loan to cost lending. What you'll see is that loan to cost lending, and one's not better than the other, they're just different. Loan to cost lending, they'll say, well, we can go up to 75% after repaired value, but you're up to, remember these words, up to, okay? Because that means there's variance and different variables that see if you qualify. But up to 90% of the purchase price or as is value, whatever is less, okay? So if you have to go loan to cost product, you're like, well, Alex, then how do I do that? Easy. Take the purchase price and look at the as is value of the property. Hopefully, as an investor, your purchase price is below the as is value. Or you're like, why are you buying it? But, and I have seen it before. So let's say, like, well, Alex, I'm going to buy this property for 100 because I think it's worth 200, and I think the repairs are 50. Easy. Your lender for the loan to cost product is going to lend $90,000 at closing, and you got to come up with 10 plus closing costs, your origination fees and your title fees and your processing fees and all that kind of stuff. Okay, so it's really, really easy math to see your out-of-pocket costs on that as well. Don't let the math overwhelm you. It's simple equations. That's why I go over the math so much. Then you have the 75% loan to value. It's more of a teaser than anything, because there's almost no way to get to the 75% unless the repairs are really, really big. And usually, if the repairs are over the purchase price, those products, loan to cost products, are usually backed by institutional banks, and they don't like that. So that usually falls out of balance anyway, because the loan to cost product is usually deployed, that product is usually deployed at like national lenders. They're backed by huge REITs and insurance companies and pension funds and securities and things like that. And that's why they can negotiate the cost of capital to, like, let's call it 2 points and 10. You'll hear a lot of people, I want 2 and 10, I want 2 and 10. Okay? You can do that, but you're coming out of pocket at closing to cover the spread. So you as an investor have to make the decision, do I like to have lower points and rates with more money in the game, or do I like to have my money in my bank account paying higher points and rate? Usually the difference is you go from 2 to 3, from loan to cost to loan to value. You go from usually 10 to 11.9. So it's not that big of a difference. But as an investor, you have to come to the understanding on how you want your money in and out. And yet we can offer both products. But you just have to come up with, hey, this is what I do. As someone who looks at a lot of businesses, I like to keep money in the bank, in my bank, okay? So I like the liquidity, because having cash on hand allows you to pivot in your business when things go wrong. And if anybody that watches this pays attention to their business, something always goes wrong. And what usually fixes it? Money and time. So I like to have more cash on hand than I do cash in the properties. Now, those are great for small balance, like small commercial, like apartment complexes, and they're great for single family. But when you go commercial on the short-term loans, this is what you gotta be concerned about. When you refinance for the long-term strategy, most if not all of your long-term lenders for commercial are going to want to see at least 20% skin in the game. So if you're not out of pocket on your commercial stuff in the front end, just be prepared to be out of pocket on your commercial loans on the back end, on the refinance, when you stabilize the NOIs. Look at it. If you want to watch the other video, yesterday's video, on I kind of went over that a little bit in detail. So you can use short-term products for distressed and reduced value assets to get that job done, okay? The other way people use short-term loans is this, as a landlord. Listen to this. I've seen landlords, and I've helped them scale their portfolios exponentially. The thing the most I've ever done for one client is 20 rentals in a year. We intermix this strategy when it was right. It's not right all the time. Is that they would close on a short-term loan. The property really didn't need anything, but they got it at such a good discount that I reduced their out-of-pocket cost at closing, and then we refinance them. So if I can close at 70% loan to value on a short-term loan within 3 days from clear to close from title and appraisal report in, and then I could refinance them at 75, and they were $0 out of pocket on their first closing. They were 0 or close to 0 on their second. That is the only time that strategy works, when there's enough equity in the property where your first closing there wasn't a lot of money down. Okay, that's the only time I suggest you do a 2 closing situation, because they're like, well, I mean, I'm paying origination points twice, and I'm doing, okay, you are, but your liquidity is still in your pocket. It is worth that, because you now have the money to put forth into another investment. It's not like it's coming out of your pocket anyway. So that is why I work with borrowers to strategize their business plan utilizing debt. So there's a ton of different products out there for investment purpose lending, for real estate. So that's why it's important that you get with somebody who knows, and not just somebody that's like, hey, I got loans, and then they just term you out and you go and you hope for the best. It's time that you guys get with people and put them on your team that can help you strategize and exit. At the end of the day, in investment real estate, the end game is exit. Are you selling this company? Are you trying to just acquire a lot of liquid wealth and strategize that way? There has to be an end in sight. Not that you'll ever stop investing, but there has to be a potential stop or slowdown. How much money is that? How do you utilize these products to do that? That is a good partner. So when you're coming over to Jet Lending and you're looking at our product matrix, there's so many that we can do that that's why there's like a lead intake form. We talk to you, we can do a Zoom call and show you the math. It's an experience. Even if you had never done a deal, we want to treat you like a seasoned, important person that's really trying to gain wealth. And that's why we do it. That's why I do it. It's why I've always done it that way. It's that people are looking to their lenders, not just give me money. It's help me. Help me do this. If you had the money, you would have done it. So you find lenders. I think it's important that you build a team around you that helps you structure debt meaning loans, that help you structure what's called a capital stack. How do I use different money products to stack buying hard assets? And that's where you get the term hard money. The money is collateralized and underwritten to the hard asset. Hard money, hard asset. It's based off the hard asset. So how do I use a capital stack to buy more of these, meaning properties? Because at the end of the day, you've opened up a business, but you don't sell hamburgers. You hold your inventory as housing or industrial yards or commercial buildings or whatever asset class you're using. And there is a product for you. Sometimes you'll have to do it your own. Sometimes you have to partner. There's always a way. It's usually what the fear of asking the question is what usually stops borrowers the most. They're afraid to ask what if. And then if they do get the answer of what if, and they say, well, I need you to do it this way, then go find a way to do it. That's where I see the most failure. People start pulling back on trying to re-strategize their business or re-platform themselves of partnering and things like that. So that's today's drive. I hope this helps. I hope you have a better feel for short-term products. It's not all encompassing. There's so much to go over. But if you need to talk about what you're trying to do, instant message me, direct message me, comment below. Tell me what you need. Okay, we'll set up a call, and hopefully I have the right product for you